Joining us this morning, TD Cowen Internet and Media Analyst John Blackledge has a buy rating, did cut his target to 100. John, happy Friday. It's good to have you back.
Yeah, thank you. Thanks for having me.
So you did trim the target, but you think this morning's action might be a bit of an overreaction?
I do. I mean, it was definitely mixed, but down over 11% pre-market. When sentiment was weak going in, stock down 40% over the past 12 months pre-open. It feels a little overdone. Just to unpack things a little bit, the results were fine for 2Q. Revenue in line, earnings were a little bit better. 3Q, they did miss small on revenue and earnings, and I think investors were concerned about that. But it was kind of like a small miss. And then for the fiscal guide, they kept revenue guide intact at the midpoint. They didn't raise the op margin guide, and I think people wanted to see that. And so that was a little disappointing. And then engagement, which has been, the biggest part of the narrative and the negative narrative, frankly. Ours were up 2% in the first half of the year. I think investors thought that it might be negative with the World Cup. And then they did change the cadence of the semi-annual engagement report to now annual, and I think that might have irked some people. But ultimately, guys, I think the biggest question is low engagement growth going to have an impact on revenue growth next year? And I think investors think revenue growth will dip below double digits, whereas management, their North Star financially is double-digit growth, driven by members, price, and ad revenue and margin expansion. And I was just looking at the numbers, that engagement report, they started in 2023. And so we don't have a long history. But in 2024, it was 3% engagement growth, 16% revenue growth. In 2025, 1.5% engagement growth, 16% revenue growth. And then in the first half of the year, 2% engagement growth, 12% revenue growth. So to what co-CEO Greg Peters was saying is kind of accurate. Not all content is created equal, and this feels just overdone to me.
I mean, certainly 12% after the run the stock has had does seem like a pretty extreme reaction, John, although I wonder how we want to read that. Because all those things you said in terms of the revenue outperforming, engagement growth over that period of time, I'm sure you have investors saying, yeah, that was password crackdown, that was starting ads from zero, and it was obviously some pricing measures, and how much more can we extrapolate from there? I just wonder if basically disruption risk is getting into this valuation as well, or if that's part of your conversations there, if AI kind of privileges YouTube relative to Netflix or anything else.
Yeah, I mean, I think they're like I said, I think people think top line growth is going to dip below double digits next year. That's going to be the debate as we round through the year. But I do also think there are catalysts from here. Their ad revenue is doubling this year. It's going to scale to over 10% of revenue in a couple of years. It's going to support margin expansion. They are doing things to broaden the content variety. They're adding podcasts. They're doing vertical video clips. So there are efforts underway to kind of drive different forms of engagement in different day parts. And the other thing that I didn't call out and that people were kind of concerned about was M&A risk. And if you look in the quarter, they repurchased almost $5 billion in share buybacks, and they have $27 billion remaining on the authorization. So I think that'll be elevated as we get through the year, and that could support shares a little bit in the back half of the year.